Many years ago when I just started working, the first big presentation I did after joining my employer, they used to have a competition between all the junior engineers every year. We started with about 30 guys, and I ended up making it to the last 3, and I had to give my first presentation to a large audience of people. What happened is they had booked out the whole town hall. There were radio DJs there with the master of ceremonies, and everything was going great. I was the last guy to talk at this long process that we went through, and for the life of me, I couldn't imagine how I was going to make it through the presentation, being the first one I had to deliver. And as I stood up and walked to the podium, the master of ceremonies piped up and said, "Well, look at this boy, doesn't he have a face for radio?" So obviously I won the competition. I got a 3 weeks all expenses paid holiday, which is not bad for somebody taking a stab at my good looks. So, okay, let's get started. As Adrian said, I used to be in the mining environment. I joined a company called Cronimet, which I believe most of you know. And what we do is we are an IPP developer. We design, finance, and manufacture and construct renewable power plants. We can either offer an EPC type of solution or an IPP solution, and we essentially in the SADC region focused on 3 solutions that we offer our clients. The first one is a PV solution which offers you cheaper daytime energy. We also have a PV diesel solution which we offer, and then we also offer load curtailment solutions to our clients, because that is increasingly becoming a more and more a greater solutions that our clients require. To give you some background, we've been instrumental in this market. We were the first company to successfully deliver a PV diesel hybrid to a mine. That project was so successful that that mine bought us out, and we were taken into the fold of Cronimet, and we now function under the name of Cronimet Mining Power Solutions. We were also the first EPC to successfully connect to the Namibian grid in a project which we completed about 3 months ago. So we've got a rich track record. We've got a very robust track record in Europe, but in Africa as well. So what I'm going to talk to you about today is the economics of different power options for mining companies. And because of my sins as a miner, I have to pay for them. And what I've realized is, when I speak to our clients in our first engagement, the question they always ask is the question that I always used to ask, is what is it going to cost? And being an engineer, I always want to give a price which is accurate to the 3rd decimal, given the current currency, exchange rates and technology prices. But I've realized that it's not that simple. And my standard answer, which some of you can discuss afterwards with me in more detail, is it depends. Because you'll see as we go through the presentation that it really does depend. So I was thinking about how to kick this presentation off, and something I thought about is, if I was to arrive here and tell you guys that I know why I'm here and I know what I'm supposed to talk about, but I can't really tell you what the next slides are going to contain, I don't think you'd be too impressed with me. You might think me to be a fool. Another analogy that I can draw is to say that, you know what, due to technical constraints on my side, I will only be able to deliver 90 to 80% of this presentation. And depending on what our presentation curtailment looks like today, I might inform you about that 5 minutes beforehand. Those are the realities that mining companies are facing. If you're being supplied with diesel fuel or with grid-tied electricity, your utility or fuel supplier cannot give you a concrete, long-term, 10-year plus view on what your pricing is going to be. And you're placing your business at risk, because a lot of your capital expenditure, and I'll touch on that a bit later, your operational expenditure gets allocated to energy. So what power generation options are there? Historically, one was either a grid-tied mine or you were an off-grid mine. Power was abundant, power was cheap. Mines used to run very, very inefficient mining loads, and things were good. Every Wednesday we'd go to the rec club and knock back a couple of beers, and life was great. Things have changed subsequently. I mean, prices are on the increase. Everybody knows that. Mining companies, in my personal capacity with my previous employer, spent millions of dollars trying to optimize our load, becoming more energy efficient, And at a certain point in time, you realize that, look, we can't flog this horse any more than we have. We have to start looking at our own generation. And that decision has to emanate from the mining house itself. So what we tend to find is we've got guys that are either on-grid or off-grid. The off-grid guys wish they had a grid connection. The on-grid guys wish they had standby generators. And somewhere in the middle, you know, we've got a hybridized solution which is able to feed your mine so that you can go about your normal day-to-day business. So what are the driving forces behind what energy costs you as a mine? Now, I mean, a lot of you guys have seen the levelized cost of electricity or energy formula. It's a fairly simple formula, but the dynamics behind that formula is where, you know, the details start to come in and where it starts to get a bit murky. The levelized cost of electricity should not be confused with a power purchase agreement price. The levelized cost of electricity is merely a means to differentiate between what the total life cycle costs of various energy sources or technologies will be over the duration of their useful life. A power purchase agreement is more, the power purchase agreement tariff in the first year is what excites mining houses, because that is what they're going to pay for energy from the first year of inception. So if we delve into this formula a bit more, you will see that obviously there's not a lot that's new in this formula. You've got your investment cost, your maintenance cost, and your fuel cost. Now, the only analogy I can draw for this formula for somebody who might not be mathematically inclined, such as myself, is that it looks very much like the total life cycle cost of an electric motor. Everybody knows that 90% of the total life cycle cost of an electric motor is expended on energy. If you're running or generating any type of electricity and there's a fuel source involved, the majority of your expenditure will not be towards a technology in the form of capex. It will rather be towards, you know, supplying this beast with fuel on a daily basis. Now, when we start talking about fuel, we start talking about volatility, because all fuels are essentially a commodity, and commodities are driven by supply and demand fundamentals. And essentially, where there's volatility, there's uncertainty, and where there's uncertainty, there's risk. And that is what business is about. Business is about mitigating your risk and showing greater profits as time progresses. When we start looking at renewables, a lot of them have feedstock to generate electricity, which is essentially free. So you're taking a huge amount of costs out of this equation. But then there are things that we rarely look at in this levelized cost of electricity formula, or which it doesn't accurately give us a true reflection of. One of those things is time. I mean, if you can give me a mine today that's got a 15-year life of mine, which is grid connected, you give me a project of sufficient scale and an off-taker which is robust, we can beat grid parity today. That is a reality. That's not just a bedtime story that I'm trying to sell you. It is the reality that we're facing today. Obviously, what the levelized cost of electricity does not look at is the complexity of the technology that you're using. Miners are miners because they mine. They are not power generators. They've got enough issues with production-related issues, unions, the Department of Mineral Resources, that they do not want to get involved in the day-to-day running of a power generation facility. Obviously, if one starts looking at debt and risk, the more solid the off-taker, the better power purchase price one can offer them. I mean, it's all about guarantees. If you give good guarantees, you get a good price. If you give excellent guarantees, you get an excellent price. And then obviously something that operating mines rarely factor into the equation, but which junior miners and guys going through a bankable feasibility study will always look at is, what is the cost of connecting to the grid? You might be in a position where you can attain access to the grid, but if you've got a fairly short life of mine, are those huge capital expenditures really worth incurring if you're only going to be operating for 7 to 10 years? So when one looks at levelized cost of electricity, this is something that we did for a client of ours, and obviously there's a lot of assumptions behind this, but that you can see renewables are really, a cost-effective manner in mitigating your risk against fuel price volatility. But that's enough said about levelized cost of electricity. Now we need to really look at what does energy cost now, where we are currently. I did a presentation a while ago where I pitched my consensus view on what the oil price is going to do in the short term. Obviously, with this oil glut that we're going through, you know, people tend to think that oil prices are going to go down and subsequently diesel prices and HFO prices will go down, but that's not always the case. It depends on where you're located. It depends on, you know, agency fees, transport costs, currency fluctuations. There's so many unknowns that it's very difficult to peg a view in the ground, which I did. And if you look at the red dot on that graph, you know, that's about the price we've been hovering at for the last 6 months. When one looks at diesel generation, there's a couple of things that one needs to consider. It's a fairly simple calculation. The efficiency of your gensets and the cost of your fuel determine what you are going to pay per kilowatt hour to generate power, either from an HFO fuel source or from a diesel genset. We know in South Africa that many miners can claim a tax rebate on their diesel costs that they incur. They can also get bulk buying discounts when compared to the gazetted price of diesel. So one needs to consider all of that. And then obviously diesel genset efficiency largely depends on, you know, what type of manufacturer you've got that is supplying you the gensets, how well you maintain those gensets, and obviously your location. So this is a graph that is also a real client of ours that we did a study for. And interestingly enough, this mining house was arguing with us about their diesel genset efficiency. So much so, because our whole business case hinges on what your efficiency is. They were under the impression that they had an extremely efficient genset, and we had to eventually get in a third party to show us what the real efficiency was, and it was significantly worse than, you know, either of us had anticipated. So what you see there is basically for a varying amount of efficiencies with a raw diesel price, an area which depicts what your energy cost will be, okay? For this specific mine at that specific point in time, they were running at about $1 a kilowatt hour. So at that price, and considering the amortization of their genset over the useful life of that genset, which is the dark blue area on that graph, they were coming in roughly at about just below 30 US dollar cents. Now, that is already a significant price to pay for diesel generation. But if one considers that we've got clients that are paying up to $1.57 in Africa for diesel, you know, you're actually moving completely off my graph. So diesel, as we all know, is very expensive, but the upfront capital, similar to the motor analogy I made, is fairly cheap and easy to implement. If you look at grid-tied electricity, Africa is faced with a huge amount of challenges. It's a great place to stay, it's a great place to do business, but there are challenges. These are just some indicative figures of what we are dealing with in Africa in terms of energy prices. There's a fairly widespread, and it depends on a whole bunch of factors. You know, landlocked countries incur more cost to deliver fuel to their generation facilities. Some guys are more reliant on hydro, some guys are more reliant on coal, and even though Africa, you know, owns or consists of 20% of the world's uranium reserves, we've only got one nuclear power station in Cape Town. So it depends largely upon what the generation mix looks like, which will determine what your price looks like. There's also a lot of issues with cross-border sales in terms of distribution and transmission lines, which have got varying voltages. I can't remember the amount of voltages that you get on the African continent where we transmit energy at, but it's significant. We also faced with aging infrastructure, you know, massive issues with budget deficits where we try to make up those budget deficits by adding taxation onto energy that we sell into the continent. I've called this slide the South African Megaflex monster. The Megaflex tariff in South Africa is by far the cheapest tariff available to any industrial client, big mining house specifically. Now, historically, well, not historically, but let's say 6 months ago, 12 months ago, we would not be having conversations with Megaflex clients about trying to beat their tariff because at that stage, the technology was still at a price which didn't make it feasible. However, there are a whole bunch of mechanisms at our disposal with which we can counteract, you know, these tariff increases that we've been seeing over the past couple of years. Now this is just an indication of what the effective tariff on a Megaflex price tariff looks. What effective tariff means is the simplest form in which a mine looks at its energy costs, and that is by just taking total bill divided by total kilowatt hours, and that is what we pay for electricity. What you need to bear in mind, if you compare this to a PV generation, technology or wind or whatever the case might be, is you offsetting energy in a very specific time of the day. And because we've got time of use tariffs, one will normally see that the time of use tariffs for PV, for instance, are significantly higher than the tariffs that you can see in this graph. So our friend from Eskom was nice enough to show us what he believes the price tariffs to be, or the trajectory to be. And I think if I had to ask everybody in this room what they think the view on Eskom prices and prices on the continent in general are, we would get varying views. And that's, again, an uncertainty which equates to a risk. In terms of PV prices, given the current, technology prices, there is a logical starting point where one can start at and say, given a specific life of mine, because all our clients are unique, I always like to say mines are like children. And please don't misquote me. I never said miners are like children. I said mines are like children. They've got their own personality, they've got their own will, and they are unique entities which need to be, looked at as a collective. So depending on what your life of mine is, the price for a PPA offtake agreement will vary. Now obviously there are mechanisms to reduce that price. If you can work on your capital structure, your debt to equity ratios, there are means of reducing that PPA price over time. We have got access to incentives. Many people think that there aren't, incentives that can be accessed to assist clients to make it more affordable for them, but there are definitely. These are tax incentives, they're cash incentives, and if you'd like to know a bit more about those incentives, please feel free to talk to me after my presentation. One thing that makes Cronimet very unique is that we are our sister company has got a trading division which operates out of Switzerland and Dubai. So we have got the ability to underwrite a PPA with a metals offtake agreement, which is something that no other solar developer, EPC, IPP can offer you. That also reduces risk, which in turn reduces your price. And then there are some other ways which we've stumbled upon, which we can optimize your price to give you the best possible price at a given point in time. So how do these stack up to against one another? Obviously, everybody knows diesel is very expensive, but kilowatt hour for kilowatt hour, you cannot beat PV or a PV diesel hybrid. I mean, the numbers speak for themselves. So I've been asked to make some forecasts about what's going to happen in future. So given my previous forecast on the oil price, I seem fairly confident, but it's a double-edged sword because it could always go the other way. So my forecasts are as follows. Electricity prices will definitely go up in future in real terms, that I can guarantee you. And it's a function of dwindling reserves, taxations and levies imposed. Everybody's talking about carbon tax, things that are imposed on our energy tariffs which a miner has got no control over. Obviously the privatization of the energy sector across the African continent is something that we see evolving as time goes by, and that will allow mines the framework in which to generate their own power. In the next 25 years, we see the cost of PV technology reducing by 50%, while fossil fuels and gas will just continuously be on the increase. And we hope and we feel that there will be more equity, debt, and incentives available to miners to institute their own generation technology on site. So, just in closing, this is a numbers game. There are only 3 or 4 times when you look at a renewable resource. You've either got power quality problems, you've got load curtailment issues, you've got security of supply issues, but it always boils down to the numbers. And there are 2 distinct scenarios that I can refer to. If you're an operational mine, you are continuously looking at the NPV of that project. And even though the operational costs have got a smaller influence on the net present value of your mining operation, I mean, making cash cost savings is never frowned upon by any management team, that I can guarantee you. If you're a greenfields mine, your MPV is very, very, very sensitive to your capital expenditure up front. So one would always try and see what capital expenditure you can strip out. And the power purchase agreement gives you the ability to strip those costs out of the business case, which just makes your new mine so much more bankable. And that's my presentation. So I would just urge you, in the current crisis that we find ourselves, you know, our biggest enemy is complacency. When one becomes complacent, you tend to accept what's currently going on as the norm, and you try and live with it. I would really urge mines, from my own experience, to grab this opportunity and look how they can potentially mitigate their cost increases, which they've got no control over. I get asked the question a lot, why would you go from the relative safety of a mining house to, you know, this chaotic pool of EPCs and developers, and which is renewable energy? And my answer to that is, I've sat on both sides of the table. You know, working for a mining house, I have seen the opportunity that there is, you know, in instituting renewable energy in your energy mix. And I believe, you know, one should always be ahead of the curve. So I would rather be part of this changing environment than being against it. So thank you very much for your time. I really appreciate it. And if there are any questions, please feel free to talk to me after the next couple of presentations. Thanks.